5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
The top business stories live from the Sky News City studio. The new bill passed in Parliament that could affect your time both in or out of the office. Also ahead, record profits for the Royal Mint as it continues to focus on sustainable precious metals. And how an AI assistant could completely replace financial analysts. Good afternoon. This is Business Live with me, Ian King. We begin with a major shake-up of the world of work. The Employment Relations Flexible Working Bill, which will give millions of employees better access to flexible working, has made its way through Parliament and it is awaiting royal assent. The Act gives workers the right to request flexible working, which includes working part-time or working from home from day one of a new job. It also obliges employers required to consider any requests and provide a reason before rejection. I've been hearing from the Business Minister, Kevin Hollinrake.
Well, the benefits are there for both employers and workers. So we know employers are struggling to find people at the moment, find staff. So this brings more people back into the workplace because we know what number one reason why somebody would return to the workplace who's left it, who's of age 50 to 65, is if they can work flexibly. So it's good for workers and good for employers, and we're trying to strike that balance. It's important to note it is a right to request rather than a right to insist on flexible working, so a day one right. So what we're trying to encourage is a conversation between workers and employers about how this job might be done more flexibly. That doesn't mean everybody works from home. It can well mean that somebody starts a bit later because they drop the kids off at school, or somebody's caring for a relative, or wants to study for a qualification, all those things to fit around people's lives. So there's the different flexibilities that might apply, that might suit a worker, that might also suit an employer.
You don't think this is going to make life harder for small businesses in particular?
I don't think so. We had the Flexible Working Task Force, which had people like the Federation of Small Business on that, and Chamber of Commerce, who represent small businesses. So I think it strikes a balance. And many businesses deal with this already. There's already a 26-week right to do this, to apply for flexible working, and it's a right to request, and the employer can refuse it on one of 8 grounds, which are simple grounds. We're just saying, have that conversation on day one. And we know from there's evidence to show if you advertise a job as being offered flexibly, you get 30% more, up to 30% more applicants, which has got to be good for employers. So I think it's a good balance to strike.
How difficult do you think some employers are going to find it, though, in proving to their workforce that there are certain roles, certain tasks where flexible working is just not applicable?
Well, you don't have to prove it. You have to have a conversation, and you have to respond to requests within 2 months. It's currently 3 months. And you can make 2 requests in a year rather than 1 request. Those are some of the changes. And it's what we're saying now is an employee doesn't have to set out the reasons why an employer could cope with this, with flexible working. But if the employer decides, if he looks at this or she looks at this and decides, no, that's not right for our business, not right for our customers or for other people in the workplace, they can refuse it. And there's no appeal mechanism to that, as long as the employer has followed the process as set out, and there'll be some clear guidelines on this from ACAS. So as long as they follow that process, there is no danger to the employer. But there is, we are seeing most employers do this anyway now. We know the world's changed since COVID. I think we recognise that people can work flexibly and still work effectively, and this is just about encouraging a conversation between workers and employers.
You're confident that the employers aren't going to be suddenly hit with a deluge of requests for flexible working then?
I don't think so, because, I mean, there are 2 million people who currently don't have this right because they're in the first 6 months of employment, of course, and that's a rolling 2 million people. But most people have this right anyway after 26 weeks. But we don't want to put pressure on business. They've had to cope with an awful lot over the last few years, COVID, and then increased costs of doing business. I'm from business myself. You know, I was in business for 30 years prior to coming into politics. Delighted to be business minister. I wouldn't do anything that was not in the interests of business, because what's in the interests of businesses is also in the interests of workers and consumers. So it's really important that we have a system that works well for all those different parties, and I think this strikes that balance.
Now, look, while we've got you, the head of the Post Office inquiry has written to you this week asking you to expedite compensation payment to these postmasters who were wrongly accused of fraud. When are they going to get their compensation?
Well, he's right to do that. We are very concerned about this too. We're trying to push this ahead as quickly as possible. We've already paid out about 140, or made offers about 140 million pounds to people who've been who have suffered as a result of the terrible goings on at the post office. So we want to do this more quickly. These matters are complex. If you're trying to assess loss, both in terms of what they call pecuniary loss, financial loss, or non-pecuniary loss, which is other distress and inconvenience and the terrible situations people were put in personally, it is complicated to do that. So we're keen to push that ahead as quickly as possible. There are other recommendations that Sir William Williams has made as well, and we respect those recommendations. We'll be studying those very carefully, but we're keen to act on them, and we are developing creative solutions that might well expedite the payment of those of the compensation to those people affected.
Now, the Competition and Markets Authority has said high food price inflation is not being driven by weak competition. The regulator published a report today warning supermarkets about displaying prices clearly and stressing it will carefully monitor whether benefits of falling commodity prices are being passed on to shoppers. Well, the report shows that operating profits in the retail grocery sector fell by 41.5% in 2022-23 compared with the previous year. Average operating margins fell from 3.2% to 1.8%, and the CMA says this is due to retailers' costs increasing faster than their revenues, indicating that rising costs have not been passed on in full to consumers. The regulator's chief executive told me it's important that people can shop around and get the best prices.
What we've been looking at really is to understand how well competition is working in the groceries market. It's obviously incredibly important at the moment. We all know that households are feeling the pressure of high food and grocery prices. We want to make sure that competition in this market is working as effectively as possible. We also want to make sure that people can shop around and compare prices and get the best deals possible. So it's a complicated market. There are a number of different product categories. And of course, it's not just about competition at the retail level. It's about competition up the supply chain too.
Some other business news stories for you now. And average two-year fixed mortgage rates fell today for the first time in 2 months. The average rate on a two-year fixed deal is now 6.79%, down from 6.81% on Wednesday. Meanwhile, the typical five-year rate fell to 6.31%. That was down from 6.33% yesterday. That's according to Moneyfacts, the data provider. The moves come a day after it emerged that the headline rate of inflation fell from 8.7% in May to 7.9% in June, which was a bigger drop than expected. The UK's offshore wind sector received a blow today when a project due to form one of the world's biggest developments was suspended. The Swedish company Vattenfall halted work on the 1.4 gigawatt Norfolk Boreas project after costs on the project rose by 40%. Vattenfall said the market for offshore wind power is challenging. Higher inflation and capital costs are affecting the entire energy sector, but the geopolitical situation has made offshore wind and its supply chain particularly vulnerable. The parent company of Royal Mail named one of its senior managers today as its new chief executive. International Distribution Services said Martin Seidenberg would take the role after a revision of its corporate structure. The company previously had no group chief executive, but instead had two individual CEOs for its two operating divisions, Royal Mail and the international parcels delivery business GLS. Mr. Seidenberg was previously chief executive of GLS. Well, IDS also reported group sales of £3 billion for the 3 months to the end of August to June. That was unchanged on the same period last year. Within that, Royal Mail sales were down 4%. And the UK's biggest supplier of kitchens to the building trade insisted today its builder customers remained busy despite the continued challenging macroeconomic backdrop. Howdens Joinery, which operates from more than 800 depots across the UK and Europe, was reporting a pre-tax profit of £111.9 million for the 24 weeks to the 10th of June. That was down 22.8% on the same period last year, which Howdens said had been an exceptionally busy period as the sector grappled with big order backlogs after the lockdowns. Now, the Royal Mint is to open a new multi-million-pound factory this year as part of a 5-year growth plan following record profits. The plant will be set up to recover gold from electronic waste and is one of 2 new divisions opened this year. The other, a new luxury jewellery business called 886 by the Royal Mint, launched in April last year. Well, the cost of the investments meant that pre-tax profits at Royal Mint fell to £12.9 million for the year to the end of March. That was down from the record, as I say, £18 million during the previous 12 months. Well, joining me now, I'm very pleased to say, is Anne Jessup. She's Chief Executive of Royal Mint. Anne, welcome to you. What's given you the confidence to do this?
Well, really, we started off in precious metals, and over the past, 3 to 4 years, we've been really focusing on how we diversify as coins are used less. And we've investigated and done a lot of work and focused on what can we be, how do we diversify? And the organisation's changed so quickly, and the people are just so proud about how we've done that. And we've really invested in where I think people would expect us to be investing in, which is in sustainability, in British craftsmanship, and really using where we started 1100 years ago and precious metals, which coins were made out of, as our basis. And I think if you use what you know about what's your DNA, then it's much easier to be successful.
Well, looking at the results, that diversification has proved a good idea because all of the profits this year have come from your consumer division and not from the coinage division.
Absolutely, that's right. Yes, people are using less coins. Before COVID, it was going down about 5% every year, but COVID showed us a step change of about 35%. So I think coins will always be important, and people want to have choice, but not only in the UK but internationally, obviously demand is down significantly, as are prices.
How rapidly are you rolling out new coinage featuring the new king?
So we've produced coins, coronation coins and the memorial coins, but in terms of the circulating coins, we've sent out 50p's of those, and we're just working on some others. But it will depend upon demand. So we won't produce coins and distribute them if it's not demanded.
How quickly do you think the old coins featuring the old queen will be phased out?
So actually, people always ask this questions and they assume they'll be phased out, but no, they're not. They'll co-circulate. So the thing about coins is they last for 20 years. And just because we've had a monarch for a very long time, nobody remembers a time when coins co-circulated with two monarchs, but that's very normal in our history. So the coins with the Queen will stay there until they're taken out of circulation because, they effectively wear out.
All right, and there's so much more I wanted to ask you, but I'm afraid we're out of time. But it's good to see you again. Thank you.
Thank you. Bye-bye.
Now, we've frequently discussed on this programme how artificial intelligence is helping many businesses transform themselves, but also its potential to destroy jobs. Well, these are quite often seen as mundane jobs. But my next guest argues that AI also threatens to cost highly paid financial analysts their jobs. Richard Carlson is Chief Executive and co-founder of Grasp, the world's first dedicated AI assistant for automating financial research. Richard, afternoon to you. What can this assistant do and what can't it do?
Well, first of all, Ian, thanks a lot for having me on your show. So Grasp is an AI tool that helps finance workers do their job better. So that is in finance. A lot of the work that's being done is manual and repetitive. So that is searching for information and putting that information down into PowerPoints, Excels, and other documents. And what we at Grasp are building is a tool that does that workflow more or less for you. So helping you find the best information and put that information down into the documents that you actually are producing. So in that case, you can spend a lot more time on the analysis part instead of the manual and repetitive work of finding information and creating this output material.
I gather you're particularly focused on identifying targets for potential mergers and acquisitions activity.
Yes, so that is one of the first features that we built. So Grasp is a 3-year-old company, and we've built it very closely together with customers over those 3 years. And the first feature that we built is the M&A analysis tool. And that's basically a tool that can find companies anywhere in the world and it basically any industry, any geography. And we have been doing 500 of these types of M&A and company scans, and we've outperformed any other methods of finding companies by more than 4x on average. So this workflow of searching for information and then putting that down into, in this case, Excel, which is what the users are outputting in it today, is working and is saving a lot of time for our customers.
And what's your hit rate been like so far?
Yeah, so obviously the M&A process is very long, and during those 3 years we have seen many deals come through, and we're hearing that every day now from projects that we are customers that have used our solution a few years ago and are actually coming through with the deals now today, and in many cases, so we find way more companies than you traditionally do, because we look at so much information. So there's millions of companies going into the system versus humans typically able to look at maybe up to 1,000 at most. So we find way more companies, and that's actually starting to show now from customers using our tool.
Richard, I know lots of investment bankers around the city who would argue that identifying M&A targets is as much of an art as it is a science.
Yeah, it's a very tedious job, and what you actually do is you basically have to go through company websites one by one to identify what is this company doing, and then evaluating if this is a good fit for a particular scope. And what you can have then is our AI tool that does that for you. So it's similar to how a human does it. It looks at the information and then evaluates, is this a fit to the scope that the customer has?
All right, we have to leave it there. I should say, by the way, you are a former investment banker as well, so you do know a bit about what you're talking about there.
Yeah,
Richard, good to see you.
Those myself. Thank you.
Still to come here on Business Live, we'll have a look at how the markets have finished here this Thursday afternoon. Stay with us.
So essentially what we're seeing is that measles rates are increasing across the UK. Most of those cases are in London, and that's on the background of the lowest rates of MMR uptake that we've seen in over a decade. So we know that measles is extremely serious infection. It can lead to serious complications and even death. And that's why we're urging people to go forth, get their vaccine if they've missed 1 or 2 doses. So there's many reasons why it's an issue. We have been seeing since COVID rates of routine childhood vaccinations decreasing across the whole world. And we also know in London that rates are generally particularly low and lower than the rest of the country. And again, there are many reasons for that, including the London being a mobile area, people coming in and out, missing vaccinations. And we also know that there are pockets of communities with very low uptake. And all of that means that we've got people within the community that are vulnerable and at risk. And that's why we need them to have the vaccine to protect them and to make sure that nobody is left behind. So we do know that that 19 to 25-year-old age group have got lower vaccine rates. And that's due to those scare stories from the 2000s, which have been seen to be completely unfounded, with many studies now that have disproven that link between autism and the MMR vaccine. We know that the vaccine is highly effective and safe. It saves many lives all the time, and most of all, it can protect from those serious complications of measles and the long-term complications. Measles can cause pneumonia, it can cause ear infections, it can cause diarrhea, but it can also cause encephalitis, that's inflammation of the brain, and it can cause death. We know that 20 to 40% of those infected will be hospitalised, so it really is something that we need to protect against, and we have a vaccine.
Fly Emirates. Fly better. Fly Emirates. Fly better.
Thank you.
Welcome back. Just want to bring you some breaking news which has just reached us, which is that Virgin Money UK has told staff today that 39 bank branches will close before the end of the year, resulting in 260 job losses. Virgin Money, of course, was formed from the merger of Virgin Money, which was itself part of the old Northern Rock, and Yorkshire Bank and Clydesdale Bank. The branches affected are Bristol, Cardiff, Liverpool, Wolverhampton and Belfast. Well, the pound sold off sharply yesterday on the soft inflation data, and it's continued to drift lower today. Here's the current picture. Sterling off another 0.75% against the US dollar, off by around 1/8% or so against the euro. The single currency, meanwhile, off by nearly 2/3% against the dollar. On the equity markets, here's how the European stock indices have all finished up, all in positive territory. Talking points today, they include the Dutch chip component supplier, ASML, one of the biggest companies in the Netherlands. It's closed 5% lower in Amsterdam after downbeat comments overnight from the Taiwanese chips giant TSMC. Well, here in London, the FTSE 100 has also finished in positive territory, up another 0.75%. The mood obviously still very buoyant after yesterday's inflation numbers. The house builders and commercial property companies are leading the charge, but the leading percentage gainer is Anglo-American. The air miner up 3.5% nearly on a production update. In the same sector, Glencore is up by a similar amount. Outside the FTSE 100, well, Babcock is the leading gainer after its results came in better than feared. Look at that, up nearly 15% on the session, while the air conditioning specialist Volution is up 4.5% on news that its results this year will be better than expected. Meanwhile, the trading platform IG Group is ahead 4% on its results. To the downside, Essential, the data and analytics specialist, has closed down nearly 9%. That's on reports that potential bidders for its consumer data arm have walked away from the auction. On Wall Street, meanwhile, the S&P 500 and the Nasdaq have opened to the downside after an adverse reaction to results posted overnight from both Netflix and Tesla. Netflix is currently down 8.5% and Tesla by nearly 7%. As for the oil price, well, that sold off last night after briefly trading above $80 a barrel. It's currently $78.89 a barrel. That is down 0.75% on the session. Joining me now is Hank Potts, Director of Investment Strategy at Barclays Private Bank. Hank, good to see you again. Very, very interesting, these results overnight from Tesla and Netflix. But here in Europe, a very, very positive mood again today.
It was another positive session on the European bourses. You're absolutely right. If you look at the stock 600, up 0.4%. Outperformance actually coming through from the FTSE 100 today, benefiting from that weaker pound, but also benefiting from stronger mining stocks as we got that production update coming through. The reality is we've seen a really strong performance from risk assets during the course of this year. I think it's been helped by resilient economic data, and actually the political backdrop has probably been a little bit more stable than was anticipated during the course of this year. You only have to look at the S&P 500, up 18.5%. Very few analysts were predicting that at the start of the year. But I think we have to be a little bit cautious about the sustainability of this rally. We do know, of course, it's been helped by the fact we've seen robust labour markets. We've seen consumers that have had excess savings built up during the course of the pandemic. There's been cushioning demand, the recovery in the service sector, and the benefits of China reopening. But the reality is many of those tailwinds are now starting to weaken. And we think it's going to be a bumpy landing for the global economy in the second half of the year. And given the fact that valuations looking a little bit stretched at the moment, it's hard to see how this rally will continue.
Hank, a lot of people got very excited yesterday with the softer than expected inflation data. Market now pricing in only a 0.25 point hike next month from the Bank of England rather than a 0.5 point, though. You still think the latter is a possibility?
Well, quite frankly, I was a little bit bemused by the market reaction and some of the headlines you see in today's paper. The truth is, of course, that headline CPI number is better for June. 7.9% is certainly better than that 8.7% that we saw in May. But we should remember that's still nearly 4 times the official target level. The truth is UK inflation has been slower to moderate than in other regions. That's partly because of how much gas the UK uses for power generation. It's a fact of the structure that was put in place to try and shield households and businesses from higher energy bills from the government policy. And of course, the disruption has been caused to the supply of goods and labour as a result of Brexit. But we still see inflation in the UK remaining elevated. We've got at 7.2% average this year. We still think it's going to be at 3% at the end of next year, above the target level. So the Bank of England is actually quite some way away from announcing a ceasefire on its battle against inflation.
Henk, got to leave it there. Good to see you again this afternoon. Thank you.
Pleasure.
That's it from me. I'm back with Business Live again tomorrow morning at 11:30. Hope to see you then. In the meantime, do stay tuned. Coming up after this break, it's Mark Austin. Cheerio.